to talking about kind of who Klaas Financial is and some of the by the numbers about the organization. So Klaas Financial has been in business for about 45 years. As a matter of fact, we were founded by my father and his brother right out of college, and they founded the organization based more or less on the golden rule that you treat others the way that you would want to be treated. That was back in 1976, and that tradition of utilizing the golden rule continues here today. We serve about a little over 1,000 households. We have 21 employees now between two different locations here in Madison, Wisconsin, and down in Northern Illinois and Rockford, Illinois. And then we have about 607 million of client assets that we directly oversee, and we serve clients in 28 different states. But at the end of the day, what we exist to do is to help individuals, families, and employers both plan and invest for retirement. At this point, I'm going to turn it over to my partner here, Todd Eklund, and he will walk us through the next portion of our presentation.
Thanks, CJ. Well, I thought we'd start out with something a little bit different today. We're in a new year and a new decade. And before we jump into sort of the outlook for the year ahead, why don't we look back in the rearview mirror a bit? I want to try a poll. So looking back in time, we're going to extend this to the audience here in a second. I wanted to ask you all, how many of the S&P 500 top 5 largest stocks back in the year 2000 are still in the top 5 today? So we'll give you 30 seconds, see what the audience weighs in. Is it all 5, 3, 1, or none of the above? All right, give you another 10 seconds or so. Don't be shy. So it's a pretty mixed bag. The audience, it's about evenly split across 3, 1, and none. But the top winner being just 1. And that's actually correct. We look back to the year 2000, seems like an eternity ago at this point. We were all worried about Y2K, but the top 5 largest stocks back in 2000 were Microsoft, Cisco, GE, Exxon, and Intel. And when we fast forward to today, just 1 is left in the top 5, Microsoft, with 4 newcomers. So a lot's changed, a lot can change. I think we're going to hit on that when we talk about the markets, the economy, looking ahead into a new decade. Now it's worth saying that, unlike Beanie Babies or AOL, some of those businesses that disappeared, ExxonMobil and GE, they're still around today, but they are much smaller businesses. So the world can really change quite a bit, and who knows what we'll be talking about in 2030. But getting back to the present, we want to talk a bit about the economy, what's gone on. As you all know, and we've talked about on past webinars, last year we had a very sharp contraction with the COVID-19. Really in historical terms, one of the most severe economic shocks the country's ever seen. And the good news is that we're seeing signs of life of a rebound. Now, that's not to say that we're out of it just yet. Technically, the United States is still in a recession. Now, when I say technically, that's important because a recession is defined as 2 consecutive quarters of negative GDP growth, which certainly, as you can still see on the chart, we are in the negative. But there's signs that we're having a good bounce back in activity after that initial shock. Now, unemployment is still quite high by historical terms. That owes to the fact that there's different subsectors of the economy that have been hit very, very hard by the pandemic, more so than others. Things like restaurant, retail, leisure and travel. But we're seeing good signs of life that the economy is on the mend, and that's a good thing. One of the unique things about this last recession is that we did not have a contraction in the housing market, and that's a big bright spot. So the good news is that home prices have been on the rise for most Americans. What we have on the screen here is the Case-Shiller 20-city home price index. So that measures home prices across 20 major cities and regional markets in the US. And you can see here that home prices have generally been appreciating at about a 10% clip over the past 6 months. And that is quite different from 2008 and past recessions that we've had, where home prices have gone down in conjunction with the economy. Another unique trend, owing to those housing prices, perhaps, is 20-somethings extending the stay at home. Now, this is truly something of the pandemic era, but the share of young adults living with their parents has hit its peak at a level not seen since the Great Depression. Now, this has been a trend that's on the rise, over the past few decades, but you can see that line continue to keep rising and rising on the right-hand side. So the good news is that for most Americans, their house is worth more than it was a year ago. The bad news, depending on your perspective, is you've probably got a couple more occupants in your house with you. So 2021 might not be the year to cash out and downsize that one story just yet. So I want to go back to the market for a second where we started, and going back to the idea of leadership in the top 5 stocks. There's been a lot of coverage in the press over the past year about the big tech names that really have driven the market. And it's important to really keep our perspective that it's tough to maintain that market leadership. It's one of the reasons why we advocate for diversified investing. We don't focus on picking individual stocks. One of the things that we emphasize to clients, quite often is you stick with it, hang on, through, if you can just wait it out, you're going to get a good result. And I'd say that wisdom doesn't play in necessarily to individual stocks. There's this idea that, well, you buy the best blue chip companies and you just hold them forever. They're going to be around forever. If we look at those top 5 stocks from the year 2000, they shrunk quite a bit over the coming decades, and a whole new set of winners emerged. It's tough to predict these things in advance, and nobody knows. But look, for people that bought those stocks like a GE, household name will be around forever. The stock price went from $50 down below 10 over the next decade. Or, Exxon, the largest energy company and a dividend bellwether, essentially went 2 decades of no growth in its market capitalization. So we really, say this, that today there's a lot of coverage about these stocks. There's so much temptation, right, to go into the high flyers. It's what's exciting, but we really think you need to stay the course. We're here to help you make really good decisions, invest well, and really optimize your likelihood of success.
Well, and to add to what Todd is saying here, we hear this often from people who will own individual equities, which is, I've been encouraged to stay the course through good and bad. And that certainly is a true part of investing in general, that you don't want to bail just because you get a little bit of a dip in the market or a bad season in a particular stock. But the idea of stick with it or ride through difficult times is really meant to be focused on globally diversified portfolios. There can be time frames when an individual company will go from boom to complete bust, or if not bust, they may never recover to their old all-time highs. So to what Todd is saying, I think this is an important concept for our listeners to understand today, that diversification is the key to making the long-term success work out. We're going to shift now to talk about U.S. tax rates versus the fiscal deficit. As
The election a bit.
the election,
We hope
yes.
to avoid it.
So as you all know, with the change in the White House, with a lot of the things going on with the elections, there's been a lot of questions that we have run across as it relates to what we think will happen in the coming years, both as it relates to the market and the economy. And while we want to stay out of the political fray on which party is better or which one is better for the stock market, because we actually addressed that topic a quarter ago. If you want to hear our perspective on which party we think is better for the stock market, I'll give you a little teaser. Go back and listen to our last one from a quarter ago, because you might be surprised what you find out. But what we did want to look at today was the history of the highest marginal income tax brackets here in the United States relative to our federal debt or fiscal deficit. So what you see here on the screen is going back to 1966 up until now, up until 2019 at least, so a couple years ago, is the history of our debt to GDP. And as you can see, back in 1966, it was about 45%. debt to GDP. GDP is gross domestic production. But now today you can see it's well over 100. And as a matter of fact, that's only through 2019. If you were to look at it today, it's closer to about 120.
The spending from the pandemic will definitely
spike that number.
it.
So think of it in terms of today, we sit at about 120% debt relative to gross domestic production. What you see now on the screen is the highest federal marginal income tax brackets that existed from 1966 moving forward to 2019. Now you'll notice what I just popped up on the screen there shows you that as of today, the highest federal marginal income tax bracket sits at 37%. But this graph should strike you. You should be pausing. You should be saying, our taxes are coming down while our debt is going up. Now, we're not going to get into the argument or the discussion about what is the right way to climb ourselves out of a hole or what caused us to get to this place that we are right now. You can listen to plenty of pundits to get their opinion about that topic. But we are going to make an observation, which that observation would be whether you are a Republican or Democrat, this is a problem that we are going to have to address through some sort of stimulus of the economy, through something to pay down that debt over time. Again, we all have opinions about what got us here, but where we stand today is going to be a problem for the future if it's not addressed. And so it wouldn't surprise us as we move forward under the Biden administration if we end up seeing some of these marginal income tax brackets change over time, maybe the federal estate tax. So those are going to be planning topics that as you all come in and speak with us, that we will be discussing different strategies that we could employ to mitigate this. Now, as you leave here today, I want to be clear. We do not believe that taxes are going to skyrocket. As a matter of fact, from what we've heard from the Biden-Harris administration, it may be very small and incremental, but it is certainly an area of planning that we will need to address as you come in and talk with your financial advisor here at the firm.
I'll just add that a hard decision has to get made somewhere. So whether it's reducing benefits or increasing taxes, it involves things that will affect people in the future. We don't know what they will be, but either way, that's why we're here to evaluate, keep tabs, and make sure that you adjust as the situation adjusts. But I think to think that this situation can exist forever, for eternity, would be ignorant.
Yes. So moving on to our next slide here, often we will either hear this from a client or we will experience the reality with them, which is diversification can feel disappointing at times because a diversified portfolio with discipline can work, though it never feels great. And I'll explain why. From the time period October 1st of 2000 to the end of 2002, for those who know this time period, this was when the tech bubble burst. You can see that the NASDAQ index declined 36.2%. So that's just all basically technology stocks. It was down 36.2%. And a diversified globally diversified portfolio of 60% equities, 40% fixed income also lost. It didn't lose as much. It was only down 6.8, but it still lost. Additionally, in 2008, the financial crisis, NASDAQ was down 40.5% in 2008. And again, a globally diversified portfolio was down 23.3. Now, in our industry, we call this a success. We look at that and say, great, we didn't lose as much. But what we often hear from our clients, which is a true statement, is, I lost money. And I don't care if you tell me I didn't lose as much, I still lost money. And then conversely, in 2009 to 2019, so this is now a 10-year cycle, you can see that the NASDAQ index cumulatively gave a 543.9% rate of return over that decade-long time frame. But a globally diversified portfolio, 60% equity, 40% income,
so boring.
Was so boring. Only a mere 144, 145 in cumulative return. And of course, what we hear there is what you see on your screens. I didn't make as much. Moving on to another example would be just this year we experienced this reality that diversification can feel disappointing. from January of this year through March 23rd, you can see that the NASDAQ fell 23.4% when this globally diversified 60/40 was down 19.3. Again, didn't lose as much, but you still lost money. And for those who don't know, this was at the beginning of the COVID crisis, where the market was uncertain what the future would look like, and markets sold off heavily in the first 3 months of this year. Now, since then, as you can see on your screens, from March 24th of this year through the end of 2020, the NASDAQ gave a cumulative recovery of 89.1, whereas the globally diversified portfolio a mere 39.7. And again, I didn't make as much. So we recognize that on a practical, experiential level, the diversification at times can feel disappointing. When the market's high flying, you want to own all stock. When the market is down, you want to be in cash. And there's something about us as human beings that says, this shouldn't be so difficult. I should just buy low and sell high. Well, for any listeners that are here today, if you've ever tried that simple strategy of just jumping in and out of the market, what we commonly refer to here in the office as flipping the light switch on and off. That's the human nature, is we want to be in the market and out of the market. When you try to do that, it comes with wild amounts of disappointment. And so that's why you hear people like us say, pick a strategy that you can live with through good times and bad, and then rebalance, stay disciplined, and stick with that globally diversified strategy.
It's boring.
It's boring. However, I don't want to end my section here on such a negative point. I want to end on a high point. What you see on your screen here is the reason why we suggest you diversify. So what you're looking at is what are called rolling 7-year returns on a quarterly basis. So each of those little bars that you see going back to 2001, 2002, all the way up to 2020 are a quarter of time, but looking back from that quarter, 7 years.
You've been invested 7 years.
7 years. So think of it as each one of those bars represents a 7-year average rate of return. And what you should recognize is that with a 60% equity, globally diversified, 40% fixed income, in the last 20 years, there was not a 7-year time frame that you would have been negative. Now, that's not a guarantee. That could certainly happen at some point during an anomaly. But look, there was not a 7-year time frame that you would have been negative. While it may be boring, it gets you to where you need to go. And I'll add to that. If we were to overlay the NASDAQ on this, you would be shocked, because there were decade-long periods, 15-year-long periods, where you did not experience a positive rate of return when you went narrow on the market. So diversification is about broadening. If you get too narrow on the market in a single sector, you can run and do long periods of time that are disappointing.
We covered that last time. If you'll recall, the bars go really high and then really low.
That's actually another good plug. Thank you, Todd. I would suggest, again, you jump back to our last quarter conference call. It's on our website under our quarterly webinar tab. I really do suggest we hit on, again, both of these topics that we mentioned earlier. But there you go. Why do we stick with diversification? While it may feel disappointing at times, it gets you to where you need to go, to where you're trying to go. And on top of that, it allows you to stay the course. So with that, we've come to the end of the core presentation section of our webinar today, and we're now going to open it up for Q&A. So we will hit the pause button here and stop talking. If all of you who are interested in submitting a question would go ahead and jump on, click on the little Q&A button at the bottom of your screen, and we will take the next 10, 15 minutes as we need to answer some questions.
So CJ, we'll start with this one that came in from the audience. How might addressing our severe income inequality impact the economy and the market? We've covered income inequality, or at least the disparity on past webinars between what happened in the economy at times in the market. You want to start with that one?
That's a deep one. That's partly philosophical and a moral question. For those who don't know, this question is a good one. If you look at historical recessions that have occurred, 2008, 2001, they were more broadly experienced by the general populace. Financial crisis hit a lot of people and a lot of consumers and businesses pretty broadly. This crisis, on the other hand, is very different. Most people know that the gap between the haves and the have-nots, or the wealthy and the poor, has widened over the last decade, but it has gotten a jolt in the last 12 months, partly due to the pandemic. So part of this question is a moral one, but how do I think it'll impact the markets? I'll be frank, I'm not quite certain. What are your thoughts?
I would say this, I think to that point, you're seeing it reflected in the markets, that the largest companies and these tech companies, and tech isn't the only sector, are immune to the pandemic in ways that small businesses or restaurants are not. And you've seen that with the extraordinary rebound that we've had, and it's reflected in how these businesses are valued and priced. Can that be sustained forever? I don't know. Will eventually result in a different, political or populist wave, perhaps.
Right.
But certainly it highlights what we've experienced this past year, looking just at the stock market.
Yeah, that's an interesting observation that Todd makes, because it almost feels counterintuitive. We would think that a reaction to this would be trying to more broadly help everyone. And yet what comes out of these experiences is that you have a few very large corporations that do extremely well, while the smaller businesses kind of limp their way along.
So we've got some interesting questions here, some additional ones. So
yep.
I heard the reference, the roaring 20s came after the Spanish flu. Do you think that we will have that after COVID?
That's a great question. So we don't make predictions on the market. We don't make predictions on the market because we think the market is constantly trying to price expectations of the future. As a matter of fact, if you understand what the market is really doing, it is a forward pricing mechanism. Whenever you try to forward price something, it inevitably has massive flaws, which is what causes the volatility in the market. So what we would say is the market seems to believe that the COVID vaccine will be a success and that the economy will come back strong. And how do I know that? Because the market is trading at very high multiples of earnings.
And that's been priced into all types of assets,
right.
Credit, debt, everything you can imagine went down during COVID has fully recovered in its pricing. It's not just the US stock market.
Right, right. So to answer that question directly, could that be an output of this? Possibly. But you know what? I want to make one other comment about that. I don't know why this doesn't get more press. I told Todd I was going to step on my soapbox for a moment. That in the last decade, which includes the Trump administration and then 6 years before that, the Obama administration. So we're talking two different political parties, the span of two different political parties, that during this last decade, we have seen the stock market as defined by the S&P 500 up 14% per year. That's called an average annualized rate of return.
That is the roaring 20s.
That is over the last decade. So today, going back 10 years, and get this, inflation as defined by CPI was only 1.74%. Said another way, we have experienced in the markets over a 12% net real rate of return in the last decade. For those who don't know this, that is almost unheard of.
It's remarkable in a historical context.
It is. Now, you'll hear of other times where the market may have been up 14, 15% over a decade, but inflation might have been 5 or 6. And so it would have eroded that return. The anomaly here is that an inflation adjusted rate of return in the last decade has just been spectacular.
Okay, we've got a lot of questions today. This is great. Thanks. Keep sending them in. So I believe that there will be a reversal of the Trump tax restructure that may very likely include increasing taxes during retirement.
Yeah.
As part of that, might there be income thresholds and testing for diminishing exclusion of Roth gains? Well, I would just maybe we could couch it. Certainly, we don't know about the Roth gains, but the idea that there'd be different tests for benefits in the future. What's your take on that?
Well, it's actually interesting to monitor Congress as it relates to Roth accounts. I don't want to get too technical from a planning standpoint on this call today, but Roth IRAs grow tax-free, at least the dollars that are in it. And a lot of people wonder why the government allows for that. And so there's been a concern that the ability to have your gains be tax-free might eventually go away. I'm not personally in that camp, although Congress could certainly do anything they wanted to. But if you actually track the activities of Congress, most congressmen make decisions on a 4-year pro forma, which is a pro forma to get reelected. And I hate to be just a little bit negative on this, but that's just the harsh reality of the democracy that we live in, that it is built on an election cycle. And therefore, what we actually find is that Congress is trying to expand some of the availability of people being able to do Roth conversions, because that injects cash into the federal government when they convert from Roth to pre-tax. So could they eventually change some of that? Yes, but what I would say to you is, if they do, we would envision that being a grandfathering, where those who have dollars in there already would be grandfathered into an old system, and then you just would be disallowed from doing new Roth contributions. That's what we've seen in terms of some of the activity around Congress as it relates to Roth accounts.
So we have another question here. How has the market been able to be so resilient after the drop early last year during COVID? I think we touched on that a little bit, but I'd say a few things. We've had some extraordinary monetary support from the Federal Reserve. And I guess that's not new, because they did that also in 2008, but they've really decided to throw the book at this in terms of support for the markets. So that certainly has helped. The other thing, and you've heard us talk about this on webinars, is that interest rates are low. That's what they're doing. They're trying to keep interest rates low. Those largest companies like the Apples can borrow, in a way that small businesses can't. It's one of the reasons why they've been very strong throughout the recession, is the ability to, borrow and push it out till another day, far more so than a small business that might not be able to access, lending at low or attractive terms.
Well, and this goes back to something Todd mentioned earlier in his discussion, or one of his slides, but the economy is not the stock market. Let me repeat that. The economy is not the stock market. So you will often hear people say that Wall Street is out of touch with Main Street. And we chuckle at that a little bit in our industry, because Wall Street isn't Main Street, it's Wall Street. It's the largest corporations that are trading on the overall market. Now, for those who don't know, 70% of our GDP is driven by us, the consumer. And so if you weaken the consumer, you will eventually weaken Wall Street, which means you'll have corporations struggling to turn profits. But you can have periods like we have just experienced, where we are in the middle of a recession.
And one of the deepest we've ever had.
And yet you would look around at the overall market and say, what's going on? The justification to that is because there are corporations like Apple, like Facebook, like Amazon, that are turning more and more profits because our dollars have aggregated to them. As a matter of fact, we could do another poll right now. How many of you have purchased something from Amazon within the last 30 days? I'll bet if we polled you, it's over 90%. And if we went back just 5 years ago, I bet it would have been no more than 10% of you. And so what I would encourage you is, be careful trying to judge the where the market is based upon what you see your next door neighbor or your local economy experiencing, because it really is more of a global picture now.
This is a good question. Going back to your 60-40 slides, CJ, do you recommend that everyone have a 60-40 split between stocks and bonds, or should that be differently based upon my age until retirement?
I'll answer that, and then I appreciate your opinion. So no, we do not suggest everybody has 60-40. We use that as a benchmark to kind of compare against, because ultimately, well, not a benchmark, a bellwether, because we have a large portion of a retiree's portfolios in something like a 60% stock, 40% bond allocation. And so we use that to kind of show you the difference between that and 100% equities. But the answer is absolutely not. We have some clients who are young, and they might have upwards of 100% of their portfolio in globally diversified equities, all the way down to our clients who are less risk tolerant, or maybe they're in their 80s or 90s and they just want to get more return than what the bank can give them, and they're 100% fixed income. So we design portfolios based upon each individual and what they're trying to accomplish, and make sure that the risk tolerance is matching that.
And one of the nice things about our financial planning process, you can have a 60-40 at one moment in time, and you get 5 good years in the markets and an unexpected inheritance. And suddenly, when we look at your numbers of what you need for retirement, you've already won the game, right? You don't need to take that much risk. And those people they can go down to a 40-60. They don't need to take the same degree of risk, earn as high of return in that circumstance, perhaps, to get to where they need to go. Right. It's one of the great things about using a financial planning process, is that you might make that decision in advance of a 2008 recession. It has nothing to do with our ability to see in a crystal ball and know what's going to happen in the economy. It just has to do with looking at your circumstance and, adjusting accordingly. But it creates a great discipline that does, tend to result in those types of, good prescient decisions, not from predicting the future, but just looking at where you're at and what you need.
You bet. Looks like we have one more question here. Do you potentially see a significant market pullback sometime in the next few years with the new administration's agenda? Great question. We don't know. I know that's not very comforting potentially to some of you listening here. Markets are very hard to predict. What we would say is the market is not pricing a pullback at this point, but it is not a perfect pricing mechanism. As I just mentioned to you, it is actually trying to predict what will happen in the future based upon present circumstances. So it is less than perfect in how it prices. And corrections or declines in the market are often just the market reassessing its appetite for risk or its expectations.
They happen every year, regardless
right.
of the administration or Congress. They're fairly normal. So
yes.
I would almost say we're not producers. I'd say yes, there'll be another correction.
Yeah, good point.
But will it be severe and prolonged, and will it be from the new administration and the bad outlook that creates? I don't think so. And right. They're fairly normal. So we're probably going to have another decline. I don't know how long it'll be. If it'll be tomorrow or in 9 months, but they are normal and recurring.
And I do want to hit on an important topic as it relates to market risk and what's happening in the economy. We do recognize that every correction, every recession in the economy looks a little bit different. This one being no exception to that rule. And so often what we will hear from our clients is, yeah, but this time is different. And I want to bolster what we hear you saying. You're right. Every time is a little bit different. It's unique and it represents risk. So certainly investing in the markets, putting money into equities, putting money into fixed income represents that risk reward trade-off. But what we would encourage you to do is, unfortunately, in order to get some sort of return, you're going to have to take risk. I did have
we cover this. I say if there's one thing I want to emphasize each and every time, it's that.
Yes.
So especially today.
We don't know when the market will go through a recession, but I can tell you that in March of this year, when we were down 36% on the S&P 500 in a matter of no time, I did not predict that the market would be up right now. And so if we were a market timing firm, you all would have lost a lot of money this year. And thankfully we're not. I don't sit around trying to time the market. Instead, we say we need to get paid over time for the exposures and risks that we take on. And we need to do it in a smart way, a globally diversified way that allows us to live through the good and the bad years, not taking on too much risk in the meantime. And as Todd said, it's very possible that you may reach a point in your life where you are done taking on principal risk in the market. And we would say if you can afford to live your life and not take on principal risk, that's a luxury that you may want to take advantage of. But most of our clients want to get some sort of return above and beyond inflation, and it requires taking on some element of risk to accomplish that.
And what is different today is interest rates and inflation, right? If you go back to 1994, right, interest rates were 7-8% in nominal terms. So just saying, I want out of the markets and into something safe, it was different back then. And so I think today, it doesn't mean we don't own bonds, or you shouldn't have any bonds, but you also have to take some risk, have the right exposures to get that return. And there isn't an alternative to just be safe and not have your money essentially, wither out over time from inflation.
Yep. Let's end with this. First off, thank you. Thank you to everybody for tuning in. We appreciate all the great questions that came in here at the end. Thank you to Todd and the portfolio management team for pulling together some great slides that we covered here today. But I do want to just empathize with everybody that these are scary and volatile times. We have seen things happen that are new, that are unique, things at the Capitol, things in riots and Kenosha, all over the place that we have not experienced before. There's uncertainty, there's restlessness. Many of us have been locked up at home for the better part of a year now. And so we empathize. We understand that these are difficult and challenging times, and yet we want to encourage you. We are actually excited by what could come out of both the vaccine and what could come in the years ahead of us as it relates to both the markets, as it relates to opening up the economy and seeing things get better. And that's not a political statement, by the way. It has nothing to do with aligning with any particular party, but we choose to remain optimistic about what the future could look like. Because ultimately, while the government may be volatile, we believe in you, the consumer, that you will get back out, you will consume, you will treat your fellow man with respect and with love. And because of that, we're optimistic about what will come. With that, we will close our time together. Thank you for the trust and confidence you've placed in us to be your retirement planning firm. If you have any questions that have come as a result of this meeting, please reach out to myself. Todd is available for client questions as well. And we will be back here in another quarter doing another one of these webinars, and we will see what has happened between now and then. Any closing thoughts?
No, thanks for joining us again. We'll see you
Great.
next quarter.
Thank you.